So good afternoon, everyone. Thank you very much for joining our webinar on private markets. This is the fifth or sixth in a series of webinars tackling different topics. We thought that now that more or less everybody is back from vacations, it's a good time to basically restart this series and tackle this topic, since it's been very, very hot topic over the last few months, if not years, right? So as a quick overview, before we start, I believe most people are aware of our USP as a company, right? So it's about turning any investment idea, any kind of asset, any kind of contract, and so on into an investable product, bankable security. And the philosophy is that, usually people can invest in a number of traditional securities, right? Somebody can buy stocks from the stock exchange or bonds or FX. What we see is that there is a possibility to significantly expand the investment universe, i.e. instruments in which somebody can invest in a very transparent and standardized way, via analyzing. So that is basically why we have been, let's say, so passionate over the last few years into having more and more broader, let's say, universe of different investment opportunities, right? With regards to the webinar itself, we have a very quick agenda here. I promise it's not as long as it looks. So basically, I will go through a quick business update as usual. We had recently some very, very good news after all. Afterwards, we'll go through in a bit more detail, single private equity deal, single private debt deal, and then basket of private equity deals, a basket of private debt deals. So we will cover these in quite some depth. Following that, we will quickly go through the main Gen2 offering, minimum amounts, where products are quoting, how somebody can buy, and so on. The platform, basically where or how somebody can use all our services and deploy and manage strategies in the market. And last but not least, we have a selection of deals. So that will be, we will showcase a number of products, structured products that we already did own private markets. So we have a selection between real estate, hedge funds, private equity, and so on. And finally, of course, there will be a Q&A session whereby I will be more than happy to receive your questions, right? The whole webinar will be recorded as usual, so that will be also available afterwards. And of course, we're always happy to receive any follow-up comments or questions on the content. Having said that, I believe most people have been seeing the news of the Series A, successful Series A completion with the help of Point72 Ventures. So we are beyond excited about raising $15 million in this opportunity. This money obviously it will be fuel, right, for the further acceleration of the growth of the company. I mean, the company is actually already profitable company, but by utilizing this amount, we will further expand in terms of jurisdictions around the world, onshore, offices, even having a broader offering of products and services, and ultimately providing to our clients and partners a better experience, a better product, and a better service, right? So that's a new chapter for the company, which already at the moment has, I would say, about 80 full-time employees, right? Now, with regards to the assets and the business itself, we will also have another milestone. As of last month or so, we bridged through $3 billion across all the products that have been already issued, right? One more very big milestone for us. It was last year, in the beginning of the year, I believe Q1, that we reached the 2 billion. Obviously, last year wasn't a particularly easy year for the financial markets, as well know. Nevertheless, we're very happy that we're at this state right now. Some additional information, we have at the moment about 250 clients and partners that are working directly with us, well over 1,000 products launched via our platform. And as somebody can see on the bottom right pie, a pretty good diversification, pretty healthy diversification between different asset classes. Obviously, These numbers keep changing depending on the market conditions and so on, but that still gives a pretty good idea of where we start. Now, where these deals are located, something which is particularly relevant actually for private markets. As you can see, we have been active in many relevant jurisdictions around the world. In this map, somebody can even see the difference between private equity, private debt, or funds, right? So we are already, let's say, well into most of the different setups and combinations of jurisdictions that somebody could encounter by doing this business. And with regards to the markets themselves, so in Gen2, we can go from the public markets, equities, bonds, and so on, private, and into the digital as well. So that's how basically we differentiate between the different groups of work. Here, for the purpose of this webinar, obviously we will focus on the private markets and more specifically on private equity and private debt, since they have quite some notable differences. The goal of the webinar will be that is that somebody at the end of it will have a pretty good understanding of what it means to create structured product that normally would be on liquid assets, but this time on illiquid assets, right? And what benefits does this give for the manager of the strategy and ultimately for the investor as well. So having said that, the reason, as mentioned before, that we are focusing on the private markets more and more, and we deploy more and more resources into doing this in the most efficient way for our client and his investor, is that, as I mentioned at the beginning, there has been a surge in the interest of investors in the asset class, right? So this is one of the metrics that somebody could refer to. Somebody could even argue that what we're doing with the private markets is somehow relatable to what the ETFs did in the market 15 or 20 years ago, right? So we believe that there is a lot of private market opportunities out there that could offer a great deal of value to investors, which at the moment, at least, is very difficult to access for the investors, either because of minimum amount to be invested or the process itself, due diligence on both sides and so on. So with our products, somebody could basically resolve all this and having a very standardized setup of institutional grade via which investors can invest. Now, to the actual business and to the way we operate, before we go to the different cases, I think it's very important to highlight that the idea is that somebody could have at any time and anywhere the full overview and control of the different products. So you have a login virtually once you're onboarded with us, and through iPhone, tablet, or PC, you control the whole process from launching the product. So there's a menu that asks you, okay, what are the underlyings, what is the strategy, what is the fee schedule you would like to have, and so on. Throughout the issuance process, to the user product lifecycle, fee management, the actual investment into private equity or loan agreements, private debt, the valuation of the products, and finally the order approvals. So every time you have an incoming order, there will be a notification in the platform saying Bank XYZ would like to subscribe 200 units on this ISIN, and then you have an accept and reject button. So everything is virtually managed through the platform, and that basically contributes in having a seamless experience into launching and managing such products, right? Having said that, it is time to go to the first example. I apologize if it looks a little bit too technical. Nevertheless, try to make it as simple as possible. So since it's the first one, we will have 4 of these slides that all follow the same pattern. So the middle section, that the issuer, that will be the special purpose vehicle, the SPV that we will incorporate for our client. So each one of our clients or partners will operate their own SPV, which is ring-fenced and standalone legal entity, i.e. bearing or having the investor not bearing a bank issuer risk, unlike the traditional securities. So there will be an SPV that will be launching different notes, i.e. issuing different notes. The notes as well are also completely segregated from one to another, i.e. in protected cells, in Guernsey. So there is full segregation, and that's always the setup we use. So in the middle of each slide, we will have the issuer that we will put in place on behalf of our client. On the right side, we will always have the assets, so the pooling of investors' money through the custodian bank. So all the notes have an ISIN cleared by SIX, SIS, the Swiss exchange, can be quoted in Bloomberg and so on. So it's a security settling DVP, delivery versus payment, like any other. And on the right side, we will always have the same constellation of investors' banks subscribing into the certificate. Now, on the left side, that is the variable part, let's say in this case. So in this particular situation, we have a target company. So it's a company that can be in any jurisdiction virtually around the world. And the purpose, the investment objective of an investment management manager is to raise capital for this company, right? So usually you say, I have identified a good company to invest, to have people investing, and I would like the easiest possible way to pool investors into this company. So the way it works is that on our side, everything, of course, will start from the platform, right? Our client will go launch the product, fill in the details, etc. Now, on our side, we do all the follow-up work in order to make this happen. So it will start from the due diligence, of course, on the target company, creating the different accounts, putting together the documentation, the term sheet of the product, opening the accounts, and finally putting the product in the market. So on a high level, let's say we have from the one side investors who have a term sheet at hand, either themselves or the investment advisor, family office, and so on, instructing the banks, the custodian banks, to place the orders. The amount of the cash is always pooled in one ring-fenced account within the product structure, and from there it's deployed into the target company. That is usually done in the form of a share purchase agreement, right? In the product lifetime, it's possible to increase this amount or even decrease depending on the market conditions. So it even gives to the manager the possibility to have a, let's say, top up, or let's say something similar to a capital call of some sort during the lifetime of the product. Now, as it's a managed product, normally it has its fees as well. So the manager can have quarterly paid management fees or performance fees at the end. This is the general framework. We already went through the private equity. So here there will be a tracker certificate, right? So the former, let's say, product will be a tracker certificate, a Delta One tracker on the valuation of the company. Now, in case we have private debt, as mentioned before, the middle and right section is virtually the same, right? So we would again have an SPV through a cell issuing a product, and then on the right side, the investors through their banks subscribing into the note. On the left side, of course, we will still have a target company borrower, but instead of a share purchase agreement, we'll have a loan agreement, right? So in this situation, somebody could argue, okay, why would somebody do equity versus debt, etc.? That normally depends on the business case. So in the private equity case, the investment thesis is normally that a company, there is some an amount invested, let's say 5 or 10 million. Then 3 or 4 years later, there is an idea for an exit or an IPO or a certain reinvestment. So the investors would participate in the appreciation of the value of the company. Whereas on the private debt, normally there is no participation in the performance, but there is it's a yielding instrument. So you could pay a certain amount of interest to the investors every quarter, 6 months, every year, and so on. Obviously, the loan agreement on the left side, so the agreement between the issuer, the SPV, and the company will have some terms that will be reflected to the side of the investors. So the company, the borrower, will actually pay an interest at the same frequency normally to the SPV, and then basically the note to the SPV will pay interest into the investors, right? And that's all organized via the bank, who will be basically the bookmaker for the product, like the paying agent. So it's a seamless exercise every quarter for the investment manager and for the investors as well. The investors will see the note booked in their bank account, receiving interest in the frequency that the term sheet dictates. Now, These both are about single cases. So we have one opportunity in private equity or one on private debt. We're also able to have multiple different companies being financed from the same instrument. So now it's basically the instrument starts behaving a bit like a fund, not legally, but in terms of the functionality. So now we will have an AMC. AMC stands for Actively Managed Certificate. It has been quite popular over the last 5 to 10 years, mostly for equities. Here in Gentoo, we're able to deploy AMCs, which have actually private equity or private debt as underlyings. The exact same principles apply. We have a cell of the SPV that is created for the product itself. The investors will subscribe through their banks, settling DVP as always. And on the left side, we will now have the possibility to have multiple purchase agreements, basically share purchase agreements for different companies. We can have the exact same situation with private debt. And we can even have all kinds of combinations. So there could be an AMC on private markets that has, 40% private equity, 60% private debt, or even a liquid part. So it could have, let's say, 70% into private markets and 30% invested in money markets or equities or anything else. So we are very flexible in that extent. We already had several hundreds of products in all these combinations, and I can say that we're always challenged. We always love to be challenged with new innovative products, right? In investment thesis. We will actually have a look in some of these by the end of the presentation. Now, having gone through the basic structures and mechanics for private equity, private debt, either single or basket investments, the idea of this slide is to give a very rough overview of how usually our offering functions. So the product is a very institutionalized product, so it can be in Bloomberg, it can be listing in Vienna with all the usual information provided about the pricing, historical pricing, the issuer, and so on. The minimum investment amount is key, I would say, in private markets. So normally our products have a minimum amount of just 10 units that can be denominated actually in any currency. Usually one unit is 1,000, equivalent of dollar, euro, Swissy, and so on. So you can say that the minimum investment amount normally is 10,000, right? Of course, this can be raised. Some of our clients have dictated or have put in place higher minimums, 50, 100, and so on. But our setup functions usually from 10 onwards with increments of just one, so 11, 12, and so on. There are no real limitations in the number of investors that can subscribe to a product or can buy a product, neither in the asset class, or let's say the asset under the product, or the, let's say, REITs globally across different countries. The standard offering is for institutional professional investors, right? Since these products are of some complexity normally, and the regulators across the world want to protect the retail investors. In Switzerland, at the moment, we can also enable the same products for retail investors, right? So you could have a product on private asset that even retail investors would be able to buy. That would mean, of course, we'll put in place the base prospectus, the KID, and so on, right? The whole mile. Now, with regards to what I consider to be the two most, let's say, important benefits in having a private market opportunity wrapped into a structured product, it's usually the fact that with such a product, you have a seamless investment, let's say, experience. So there is no need for the investment manager to do KYC on the end investor, because the orders would always come from their banks, right? Custodian banks. So there is no custodian bank, as far as I know, that doesn't do that. So it's something that the investor doesn't need to do, neither the manager. So you have a very low minimum. There is no cost for the manager to accept an order. He just needs to click accept on the platform. And then the other one is that the product acts as an overlay between the investors and the actual target. That means that you can have higher liquidity, even if the actual asset doesn't provide liquidity. So let's say somebody creates a tracker certificate on a private equity opportunity, that means that it runs for 5 years, and the money invested has to stay there for 5 years until the exit. Nevertheless, if there is an investor who is already invested and would like to exit prematurely before the termination of the product, his manager or his advisor is able to basically have his notes sold to another counterparty in a very seamless way. So one can argue that via this setup, you can actually have some liquidity for the investors. Now, with regards to the actual example, so we have now covered the outlook, the different products and the different benefits, as well as the main components of our setup. So the idea now is to, let's say, expose or inspire people to a number of very diverse deals that we have already done. So we have 2 slides. I will very briefly touch upon the different opportunities. So we had several actually by now products on art. The idea here is actually the same more or less. So we would like to have the best possible way to pool investor capital into artwork. So here the idea is that again, we have a product that has an ISIN cleared by 6. Investors can subscribe to the product through the banks, and then on the other side, the manager is able to invest this amount into art pieces. Of course, for the setup to function, there has to be all kinds of contracts and agreement in place, like storage agreement and so on, as usually happens with art. But it's actually a fantastic way to, in quotes, let's say, fractionalize, right? It's not exactly as some firms have done it in the US and so on. It's actually something that an investor can book in his bank account. So somebody can argue that it's a very, very transparent way for somebody to participate in art in very low minimums. Now, the second opportunity on the right, it's a tracker on a biotech company. So in the same analogy, the manager pulled investor capital into the investing into a biotech company. So the investors have the possibility to participate in the uptick of the valuation of the company. Talking about the valuation, basically what happens is that when the product is launched, we will ask every when would the manager like to have a reevaluation of the note, right? Normally, for private equity, this is not very often, right? So obviously, if we have liquid instruments inside, we as N2 can also support daily reevaluation. Private markets can be quarterly, semi-annually, annually, or ad hoc, right? So basically, then the next question is who provides the valuation of the company? That is normally a specialized third party, can be from a big 4 firm to a very specialized company, depending the asset, right? So when the product is launched, let's say the investment target is 10 million. 10 million would mean 10,000 certificates on 1,000 each. So the amount is invested into the company by purchasing private shares at a certain company valuation. And then let's say 5 years later, when there is an exit, when the company is sold or there's an IPO, basically the new valuation of the company will be taken into account, and that is the performance that will be paid back to the investors. The third option, the third example here is selling or real estate. Ultimately, if a company is active in real estate or shipping or some industrial activity that is not very relevant, let's say, for the product, is more about if it's equity investment debt, is the debt secure, unsecure, and so on. So for selling on real estate, usually the thesis is that a manager has identified real estate, specific building or portfolio that yields rental income. And based on that rental income, the product is able to attribute interest to the investors at a certain frequency. That interest, the amount can be fixed. So you can say, for example, the product is paying a coupon of, I don't know, let's say 8% per annum, or it can be conditional to certain market elements like LIBOR or so. It can be over a spread. It can have 2 components, maybe one guaranteed component of coupon interest and one conditional, or it can be completely discretionary, right? You can say that I will raise set amount of money to be invested somewhere. I have some target or some expectation about the interest that will be paid, but it's not guaranteed for the investor. The fourth idea here is an AMC on VC portfolio of VC. So the biggest benefit here is virtually that somebody can invest into a note with, again, a very low minimum and a very transparent process to his bank that is actually giving him exposure to a number of different, usually private equity opportunities, right? So once again, the cash is pulled from the investors, deployed into a number of VC opportunities. For each one of them, of course, there will be normally a separate sales agreement, right? So that the SPV is able to get a piece of the company at a certain valuation. So here, our valuations team will basically produce the aggregate price of the note at the specific intervals, right? So, for example, I mean, when there are multiple, because they might have different events, it's not unusual to have quarterly or semi-annual valuation of the product. So, let's say every quarter, for example, if there are 5 or 6 or 7, etc., different private equity shares booked in the product, our valuations team would basically sum virtually the latest valuation for all of these, and then based on that, determine the price of the product. Now, on the next slide, a few more possibilities that are there. The first one, AMC of hedge funds, is something that has seen a lot of traction over the last few months. Very similar use case to a basket of private equity or so, and actually the funds by themselves is a very big chunk of the business. So here we can argue that somebody can get exposure to some premium hedge funds that have either very difficult access, right, very limited access, or each one has a very high minimum. So let's say if somebody would like to invest in a fund with 500K, 1 million or 10 million minimum, is virtually impossible, right, for a single investor, unless it's ultra high or intends to have a very high concentration into that asset. Here we can have an investor who can invest as little as 10,000, right, and the basket might comprise of 5 or even more hedge funds. So it's actually a very, very useful tool for a manager that would like to expose his investors into the specific asset class. The second in this slide opportunity, an AMC on physical commodities. So besides, let's say in the previous examples, having private equity, private debt, and generally the product investing into a company, we can also have the product investing directly into physical commodities. We have had recently a very interesting case of an AMC on physical uranium. The first one, as far as I'm concerned, launched into this format. But as an extent, as you can imagine, we have quite a number of AMCs on precious metals like gold, silver, or other industrial commodities such as copper, lithium, and so on. So here, once again, it's a very, let's say, transparent and efficient way for an investor to get direct exposure to physical commodities versus being invested in an ETF or another, let's say, indirect way of investment into these commodities. The third opportunity here is about shipping. So we had already several products on shipping, on containers, and so on. Being an AMC is able to invest either in an equity form or debt or convertible bond or other, let's say, derivatives. Now, the actual business case will depend again on whether the thesis is to provide investors exposure to the value appreciation of the underlying assets, vessels or other assets, or if we intend to raise some capital, deploy it into vessels or, let's say, yielding assets, so that basically that would result into an equity, a coupon to the investor, right? So on one side, we have something that has no intermediate cash flows, and whenever there is an exit, then this would be attributed to the investors. On the other hand, we can have something that would just yield interest to the investors and doesn't really have participation at the end. The last opportunity we see here is one on classic cars. Actually, recently, also because of the increase of the value of certain cars over the last couple of years, we have seen a lot of requests on that. It's a very interesting asset class indeed, since it's one can argue that is uncorrelated to a number of other assets. So again, exact same principle, although here normally it will not be a yielding instrument, right? Because you know, you can argue whether you can deploy or utilize the cars in a way that produce yield, but it's something usually that would bet on the price appreciation of the cars, which then upon sell or selling of the car, this can be attributed with a coupon or partial redemption, etc. So these have been now 8 examples that you know, I have to say there have been several of them quite niche, let's say. So you know, there is let's say the bread and butter of the businesses on private markets is private equity and private debt and companies around the world. We just thought that it would be very nice to expose the audience to a number of very diverse opportunities, because it's a market which is, let's say, at its beginning now. There have been a lot of counterparties that we have been in contact recently that were not aware that this is possible, and it's a market that is growing rapidly. So I hope that we managed to provide with a pretty good insight of how the base case at least would work, and also what would be possible across different assets. Having said that, it's time to go to our Q&A. So I think we can open, sorry, yes, one more slide. These stories virtually are basically stories from real products, right? And we have a section in the new website that we have put in place since about a week. So everybody's more than welcome to go to the website and have a look in the different cases, right? So there is a small description of the use case. And on our side, we're more than happy to get in touch and explain how it works, potentially even bring in contact with the people in charge, right? So having said that, it's time to go to our Q&A session, and we can open the floor. So I will try to be as efficient as possible, since the last few times we had an exorbitant amount of questions, which is very promising, of course. So going to the first questions, what are the investments restrictions, if any? So virtually, there is let's say there's originally an onboarding of the counterparty acting as the manager on, and that's the direct counterparty dealing with us, right, for that product. And then basically for the different assets, we have a pretty much standardized set of questions. So let's say for private equity, we will ask for the certificate of incorporation of the target company, the directors, share purchase agreement, and so on. If it's about private debt, then there we would more or less need the same information about the company, but then we will ask further, is it secured, is it unsecured, are there assets pledged, what are the specific agreements and economics on them, etc., etc. Is the Guernsey PCC transferable? So that is basically a question that depends a lot on the specific case, right? So basically there, what we have to see is what exactly is the portfolio of assets, and how this could be transferred in the specific context. So in case there is such a request or such a live case, we'll be more than happy to discuss. I see that we're going a bit over the time. Maybe on a question that just came, and it's very let's say common. What are the minimums for a specific case to be invested, right? So on our setup, we don't really impose a minimum per product. So normally, I would say from $1.2 million and above, it makes sense economically, depending on the case. There is no minimum starting size for a specific note, but virtually we have an overall pricing strategy that depends on the total assets under the SPV, right? And that depends a bit on the case. So once again, if there is a question about that, we'll be more than happy to elaborate further. what is basically the relationship between the investors, Gen2, and the manager. So an investor does not need to be onboarded to with a specific manager or with us as Gen2 or other counterparties, and that's actually the beauty of having certificates, right? An investor is able to have the term sheet either himself or through his investment advisor, go to his bank, to his custodian bank, and then basically from there place an order, right? That is actually in big, let's say, sharp contrast when somebody would like to invest directly in private equity or private debt, whereby both parties will need to be onboarded, right? So virtually on our side, an additional, let's say, service or offering we have is that we organize quite often investors days. The largest one, of course, is in Zurich. Usually takes place in Kaufleuten during the summer. Last time we had more than 800 participants, but actually came to our event. So there we give the opportunity to several of our clients and partners to get on the stage and talk about the different deals that they do, and basically get a very large exposure versus the buy side, right? So there are quite a few other smaller events that we organized throughout the year. There was one in Lugano earlier this year. There will be one in Davos during the WEF in the beginning of next year, and so on. So basically, we are kind of in the middle of a very active community of different counterparties who have different roles, and of course, there are a lot of synergies by bringing these people together. Another actually very good question on the liquidity of these instruments, right? So as you can imagine, having an illiquid asset, right, means that from the, let's say, left side of the equation, as we looked at the diagrams from the asset side, this is pretty much pegged that it has to go until maturity, right? Excuse me. On the right side, though, we do have a certificate that has a certain price and is traded virtually. So it's true that we don't, let's say, provide a market making role, because that means that we will have to provide actual liquidity, cash, in case of redemption. But basically, we have an investor that holds a note at his hand, and in case he would like to sell it back, first of all, legally, usually the term sheet mentions that this is done at best effort, so that the investment manager is not obligated to provide liquidity. And after all, it's a private market, private equity, private debt investment. But the investment manager also is able to identify another party in the market who will be willing to take over this position, in which case it's a very simple transaction, right? And for that, usually there is also a liquidity fee embedded, which is also mentioned in the term sheet, as all fees actually are, because it's a very transparent setup. So it's a win-win for all parties, because the investor is able to get out, and for the investment manager, it's basically worth his effort, right? Now, in case of how do we basically qualify the different investments, on our side, as Gen2, we will not, let's say, really engage into a discussion on the commercial viability and the commercial success of different projects. After all, this is the job, the duty of the investment manager, who is proposing a certain investment to his client. Our process is compiled from basically us doing the basic AML KYC due diligence on the private markets. It's, let's say, the usual standard documents and the standard process that somebody would do when he would like to invest, so nothing extraordinary there. And from there, basically ensuring that all the parties being connected into the setup fulfill certain requirements, so that when the investor ultimately is able to buy this from his bank, he's operating within a, let's say, watertight environment, that there is, let's say, no probability that the actual investment is not what the term sheet dictates, right? Having said that, I mean, I still have quite a few other questions, but I think we have reached the maximum time for the webinar. Once again, I would like to thank everyone for the participation. Actually, this was a record high webinar in terms of registration interest. We have more than I believe, 240 participants, which is a record for us as well. So thank you very much. We will publish the recording and the slides. That will be also published through the website and so on. And looking forward to chatting with different counterparties on the different opportunities. Thank you very much. Wishing you a fantastic afternoon. Ciao, ciao.